Owning 51% gives founders an illusion of control. Guy Kawasaki.
Welcome to Analyzing Finance with Nick. Today we're going to be doing a continuation on our series about why a lot of old money families don't actually own the asset or the company that made them rich to begin with. Outside of the real estate industry and very closely held private family-owned companies, most of the old money fortunes, particularly in the billionaire category, are no longer actually held with the founding generation. By the third generation, over 92% of S&P 500 companies have completely transitioned to professional management, and the founding family has a de minimis stake, if any, in the same asset that got them to be the wealthy families that they are today. But why is this the case? In this video, I'm going to attempt to break down some of the common reasons why founding families often lose control of their businesses. This doesn't just apply to old money families, but it applies to modern founders too. And oftentimes, the same type of management that allows you to start and build the company from scratch is oftentimes not the best one to maintain a company's market share or relative standing or grow to the next level once it has been started and proven to be a viable company. And unfortunately, a lot of founders kind of learn that the hard way. Before we get started, I'd just like to announce that I have been working on improving some of the technical capabilities, and I've upgraded my recording and editing software. So if you notice that the production quality on this video is better or worse, let me know, give me feedback, because I'm always trying to improve the quality of the content that I make on this channel. So first, as we've seen with the statistics that I've posted on this chart right here, there has been a material decline in generation of founder control or founder influence. Usually the founders of the company, if they're not completely diluted out by venture capital, tries to maintain a material stake in the company of something they worked hard to build, and it's tough for them to let it go. The children are often good stewards of capital because they saw their parents go through the hard times of building the business in their youth. They grew up in the company, so they understand how to be good stewards, or at least know when they are no longer qualified to run the company and hand it to professional management. By the time you get to the third generation and after, they are generally so disconnected from the founding energy of the company or the values learned from and the skills learned for building a company that they have either lacked the interest or lack the aptitude to really take over. Usually this is when professional management has taken over, and a lot of investment advisors or their own personal financial planning has led to diversification or liquidation to cover lifestyle expenses. What causes it? First, a lack of interest or a lack of aptitude for succeeding generations to maintain the business. When you grow up with more privilege and you already are wealthy from a company's efforts that did not happen in your living memory, you are less willing to want to get involved in the family business. Maybe you want to build your own identity that's separate, or maybe the talent that your grandparents had for building a business did not really pass down for you, and you were more suited to something else, or you don't have the hunger or drive to be an entrepreneur because you already have a life of comfort. As a result, like the edge or the drive and the entrepreneurial spirit oftentimes doesn't make it down 3 generations, and that leads to the succeeding generation getting into a completely different industry, or just living a life of leisure, selling company shares, or living off dividends to pay for it. The other thing that generational issues cause is there's often too many heirs. So say, for example, you have a founder who's successful, and wealthier people tend to have more children, all things equal, and he has 4 children, and each of his 4 children have 3 children themselves. So now you have 12 grandchildren, and your stake in the company at the beginning might have been 50% after getting initial fundraising for venture capital or issuing equity to early employees. By the time you go public and dilute to finance the initial public offering, or you sell some to diversify your own investments, because generally it's not prudent to have all your money in the same pot as your primary source of income. So it is prudent to diversify. Maybe that stake has gone down from 50% to say 24% by the third generation, whether due to inheritance taxes or further diversification among the parents. These grandchildren often end up with 1% or less of the company after taxes, after generational diversification and splits among all of them. And so the larger number of grandchildren and the estate tax pressures, there are things you can do with trusts, and I've done videos on that, but those aren't perfect at the size we're talking about. There likely is going to be some estate tax friction. That could lead to the family influence being a lot smaller. There are 12 different individuals. By the time they're adults, they're 12 different families. And they may not line up on anything, even if they are cousins or siblings. The other thing, too, is that's assuming estate planning goes smoothly and is done well in each generation. A lot of times there's poor estate planning, and siblings, especially in wealthy families, often tend to get litigious with each other and fight, and that destroys the estate because of all the money burnt in these estate battles. The other thing, too, with this is even if they all kept their ownership, if you go just one more generation to the fourth generation, they're still fairly wealthy people. They have an average of 3 kids each. Then those 12 are going to have 36 great-grandchildren from that same founding family. And by then, any remaining share in the company is not going to show up in any filings because it's well under the reporting levels needed, and it's de minimis. This is how the founding family shares of the company often disappear from public record, or just disappears outright. Outside of estate planning and generational transition, the other real and lack of entrepreneurial drive, the other real thing is diversification. Most companies tend not to last multiple generations. Like if you look at the history of publicly traded companies, most companies fail within a generation or two, or they're delisted, whether they're acquired in an M&A process. And so if they're acquired, they might get shares in the new company, might be paid out in cash, and so their stake in the old company is gone because the old company no longer exists, or they were just liquidated. Or the company might fail, which is a real risk. Obsolescence doesn't just affect careers, it also affects companies. Companies that used to be big players in the world, like Eastman Kodak, Sears, that got disrupted by technology, are no longer here. And there are many other examples. So it's very prudent generally, and the family offices and the wealth managers that tend to manage the money of these people are going to tell their client, look, I know you love your company, but you can't have everything in here, because if you do, and the fortunes of your industry turn, or you have technological disruption that makes your company's product or service obsolete, your family fortune will be obliterated. So they do the smart thing and they diversify. They buy real estate, invest in other publicly traded companies, do some private equity, or start different ventures, and a variety of other alternative assets. That diversification comes at the expense of maintaining ownership of the company. The diversification efforts ultimately end up still relatively wealthy and a strong family fortune, but now, instead of relying on the growth of your family-founded company, your wealth is based on the appreciation of a diversified portfolio. Example really of that would include the Rockefellers, who completely diversified out of the oil industry by the end of the 2010s. It's the same with several other old money families, and even a lot of new money tech founders like the Jobs family and the Wozniaks have diversified out of their shares as well. The other thing is founder priorities. A lot of founders either don't have children, so there really is no heir to pass it down, or they, for some reason, don't believe all their assets should be transferred down and they should donate it. A lot of industry titans such as Warren Buffett, Carnegie, and Zuckerberg are planning on donating large parts of their fortune after their death. Since that's going to be donated to charitable causes, it won't go down to the heirs, and so therefore the shares that the heirs remaining get may not be material enough to have any real control or a material ownership stake in the company. And then the other thing is public company pressures hit these families hard. If you get to the size that you are big enough to be publicly traded or acquired by private equity, it's a different ballgame than the skills it took to start a business. It's not guaranteed, but it is quite common once a company gets to a certain size, the founder is replaced by professional management to take the company to the next level. Like an old example would be like Travis Kalanick getting kicked out and being replaced by the former Expedia CEO, Dara, I don't really remember his last name, at Uber. And that's just one of many. And this is often what happens. The founder gets kicked out. They're not happy the fact that they don't really have a say anymore in the thing they built. And so they'll often sell their shares and diversify, because even if you get kicked out, you don't lose your equity. So you still have the wealth of the company, and they might use that for something else and diversify. Public company pressures, whether it's having to face the scrutiny of earnings reports every quarter and your stock price fluctuating rapidly, puts a lot of stress on founding families. Founding families generally don't think in that way to please shareholders or PR consequences. They voluntarily step back, and often public management is paid in stock comp, which dilutes the founding family stake. And when they do go public, they have to issue an IPO, which means they're either selling some of their shares directly or diluting their existing stake. Tech scaling fast is very important. A lot of founders now are scaling through raising venture capital. And with having venture capital buy into your company, your percentage is going down, but most people would take that trade. They'd rather have 20% of a $1 billion company than 100% of a $1 million company, or a company that's worthless. If you fail to scale, you'll get beat by your competitor who did take VC funding. This more diffuse ownership at the beginning means that by the time it goes to generational issues, they're all gone anyway. Also, a lot of succeeding generation family doesn't want to deal with the stress and hassle of publicly traded companies. Because the public owns the majority of the shares, it's more difficult for families, as my guest Malcolm pointed out when we talked about why old money is dying, just to hire an academically struggling family member or a modestly ambitious family member to have some cushy job within the company. You can do that when it's your company and it's you and a few partners who own it. You could put your underachieving son and daughter in some harmless, like mid-level executive position, pay them a nice salary, and allow them to enjoy a life of old money leisure. But when it's not your money, but a shareholder's money that is doing the hiring and firing of staff, that's simply not permitted anymore. And so therefore, like, that source of comfortable employment is gone. Now the heirs, if they want to live the more life of leisure and aren't really intrinsically motivated, are going to have to live off of the shares. If they don't pay a dividend, they're going to have to create their own dividend by selling the shares off gradually. Or if they do pay a dividend, they could maybe live off the dividends, but it might be tempting, just given like how expensive tastes a lot of these people are, to sell, and that will also cause further dilution out. And then there's also the overall, that's often why these families are not big shareholders in 3 generations. The stresses and pressures of running a large publicly traded company are just not worth the hassle. The lack of entrepreneurial and generational edge being passed down the generations, estate planning and natural dilution through larger generation sizes has a role to play. And the fact that a lot of companies now had to grow through outside financing impacts that too. So it's not one single straw that breaks the camel's back, but a variety of economic forces that result in founding families being displaced. And they're not all negative. Diversification is an example of one that is generally going to result in the family fortune being more than it would have if you stuck into the original family business. So it's a variety of factors: generational, estate planning, diversification, public company pressures, and outside investors forcing them out. Let me know what you think. Are you a founder who's had to worry about being forced out of your company? How would you manage this situation in terms of a family business? Would you want to stay in the family business as it matures, or would you want to IPO and toss it to professional management? Let me know, and thank you everybody for watching today.